Let's talk a little bit more about real estate and the outlook for it. And we're pleased to welcome Chad Tredway. He is head of real estate Americas at JPMorgan Asset Management to kind of give us his outlook on how things are going to look in 2025. And Chad, you were just telling us how in the last 60 days, there's really been a sea change here in terms of how investors are thinking about real estate as part of their portfolio.
So we are seeing it in real time. It's been pretty amazing just to watch the markets. Things are happening incredibly quickly. A year ago, clients looked at real estate, it was out of favor. Fast forward to today, things are changing, and here's why. When you look at just relative value, the stock market has climbed by 50% in the last 2 years. But real estate, on the other hand, is down by 25%. So for the investors that we know, that we talk to on the ground, what they're saying is now may be the time to rotate out of equities because they've appreciated so much, and now's the time to go into real estate.
So when they go into real estate, what are they looking at and what are their priorities in terms of what they want to get out of that asset?
So it's interesting. The two things that come up more than anything else right now are cash flow and appreciation. So if you look at where we're investing, it's been across three themes because of this. The first one's housing. So we all know that housing in the United States has been challenged. It's incredibly difficult to find enough housing units for the demand. But what most people don't know is that the average age of a first-time home buyer is now 40 years old. So we've been focused on single family for rent. It provides appreciation, strong demand. We actually build the houses. So we're adding to the supply. We're not taking houses out of communities. Secondly is logistics. Clients focused on driving cash flow and appreciation totally understand this, and we see it all in our own life, by the way. So we're used to ordering goods on our phone, on the computer, and we want it there same day. Before COVID, you would order goods and they would come to your house in 4 days. Today, it's a day and a half, and what's exciting about that is we buy all the real estate associated with logistics, truck terminals, industrial outdoor storage, infill properties, all which help you get assets to your doorstep much faster.
I am curious as to what type of competition you see for those assets, though, because a lot of people are thinking like you, too. They look at the housing market, they see opportunity in residential real estate. They look at all the stuff we buy online, they see opportunity in logistics. There are a lot of people going after the same assets.
That's exactly right. So where we really focus are fragmentation. So we look for inefficiencies in the market. We look for industrial outdoor storage where it's more fragmented, there's more owner users, more family users, and we have a data advantage being JPMorgan. We also look for trends that are coming. So our investors rely on us to understand what's going to happen. And so things like logistics and things like e-commerce are something that we see day to day.
So how hard is it, though, for you and your team to sort of find the right opportunities? Because we talk about investing, let's just take stock investing. To a large extent, a lot of it is kind of top down. You kind of start from the top, work your way down. That's not to dismiss the bottom up investors. Real estate is almost always bottom up. I mean, you have to have a view of what's going on the ground at a local level, right, to make a good decision, I would assume?
It's both, tops down and bottoms up.
Okay.
So we follow the consumer. We follow business. We understand key trends. But the other thing is we've got 6 years of track record. So we are in the markets. The hustle factor is real. We're in the markets talking to people every single day. And what's nice is we own over 65,000 units across the country just with apartment. We own thousands of acres of industrial outdoor storage, and so we have a built-in information advantage.
Is there a geographic focus to that, or are you just kind of spread out around the country?
So look at migration trends. You look at the top 10 places that people are moving from California, from New York, from high-income states, it tends to be into the Sun Belt. So we have focused a lot of our efforts for acquisitions and our funds in the Sun Belt.
Is that getting too crowded? There are too many players in there?
A lot of people believe that the Sun Belt is too crowded. There's been too much building. And yes, we did see a slowdown earlier in the year, but guess what? There has not been a lot of new construction. So what we're seeing now is 2025 and 2026, we're seeing demand actually accelerate, and we see rent growth on the horizon.
So one thing that you've noticed is that the benchmark for institutional quality core real estate, there's an index that tracks that, has posted its first positive rent in over 2 years. What is your confidence that this is actually the beginning of an upturn, a sustainable upturn, as opposed to, a pause and, a steady downdraft?
So if you look at the data, which has been fascinating, the core Odyssey index was negative for 2 straight years, and it turned in Q3 of this year. Huge buy signal for a number of investors. So we saw investors start to leg in Q3, as this turns, and typically you get a 10+ year investment cycle or appreciation cycle once the Odyssey turns.
That's interesting. So when we talk about people coming in here for opportunities, and they're not necessarily saying we want to beat the stock market, so to speak, right? But the idea is that the amount of returns that you get, at least maybe relative to other alternative assets, you think that's going to be better in the real estate space?
Well, we have to remember, real estate's not correlated to stocks or bonds.
It's not supposed to be.
It's not supposed to be.
Okay, yeah.
And it's going to offer diversification. It should offer inflation protection. It should be a good bellwether for your portfolio, which is exciting for us. So our investors look at it and they say, okay, if we can get the appreciation, if we can get cash flow that grows, if we're investing in high growth real estate, we feel pretty good about the prospects of it.
You've talked a lot about residential, logistics, a few other things that I'm forgetting. You haven't talked a whole lot about office space, and I'm talking about real office space here. I mean, a year and a half ago, it was all gloom and doom. We were just waiting for this wave of bankruptcies, this wave of defaults. That never really occurred. I mean, we had a few here and there, but they were more strategic defaults rather than just companies going belly up. What's happening there?
So the stat I love the most here is 80% of CEOs want their employees back in the office. 6 months ago, it was 35%. So I do think you're going to see office recover. We're seeing gains in office. Obviously, JPMorgan is a big office user. We have our new headquarters going up on Park Avenue.
Yeah.
The winners in office are technology enabled, have great amenities, and both clients and employees actually want to go to the space. But we've all been to the office space that nobody wants. We've all been there. And so what we find is 60% of overall market vacancies are in 10% of office assets.
Oh, wow.
So there's real winners and losers.